Hey there, welcome back to Audiobook Drift. Today, we're going to dive into what is widely considered the Bible of investing, The Intelligent Investor, by Benjamin Graham. This book has shaped the philosophies of some of the most successful investors, including Warren Buffett, who famously called it the best book on investing ever written. If you're ready to explore timeless principles that will transform your approach to investing and financial growth, stay tuned. Now let's get started. Chapter 1. Investment versus speculation. Graham kicks off the book by distinguishing between investment and speculation. An investment, he states, is an operation that, through thorough analysis, promises safety of principal and an adequate return. Anything else is speculation. Graham warns against getting caught up in market hype and advises focusing on sound, rational strategies. The key takeaway is that while speculators are driven by potential short-term gains, true investors are in it for sustainable, long-term returns. Always ask yourself, am I investing based on a solid foundation, or am I speculating on trends and market sentiment? Chapter 2. The Investor and Inflation. Chapter 2 addresses a concern that every investor faces at some point: inflation. Graham explains how inflation erodes the purchasing power of money and consequently affects investment returns. He advises diversifying your portfolio to hedge against inflation, highlighting the importance of stocks, bonds, and other asset classes. While bonds may offer stability, stocks provide a better long-term defense against inflation due to their potential for growth. Graham emphasizes that the wise investor needs to balance these to maintain purchasing power over time. Chapter 3. A Century of Stock Market History. In this chapter, Graham provides an insightful history of stock market trends, illustrating the cycles of bull and bear markets over the years. He notes that understanding these cycles is essential for investors to manage their expectations and avoid emotional decision-making. The key message here is that the market fluctuates and these cycles are inevitable. Being aware of history helps investors stay grounded during periods of extreme optimism or fear. Chapter 4. General Portfolio Policy, The Defensive Investor. Graham divides investors into two main types: defensive investors and enterprising investors. This chapter focuses on the defensive investor, who prioritizes safety and is not interested in constantly analyzing the market. Graham recommends a balanced approach, typically a 50-50 split between stocks and bonds. He advises that the defensive investor should aim for simplicity and low-risk investments, such as high-grade bonds and well-established stocks, to build a resilient portfolio that can weather market fluctuations. Chapter 5. The Enterprising Investor. If you're willing to put in more time and effort, you might be an enterprising investor. Graham outlines strategies that go beyond the basics, like searching for undervalued stocks or bargain issues. He stresses, however, that this approach requires thorough research and a disciplined mindset to avoid emotional decisions. An enterprising investor should look for stocks that have strong fundamentals but are temporarily underpriced. The goal is to buy low and hold until the true value is realized. Chapter 8. The Investor and Market Fluctuations. Chapter 8 is one of the most quoted sections of the book and focuses on how to handle market fluctuations. Graham introduces the concept of Mr. Market, an allegory that represents the stock market's tendency to be highly emotional and erratic. Graham teaches that investors should treat Mr. Market as a partner who offers buying and selling opportunities. If Mr. Market's mood swings wildly, don't react impulsively. Instead, see it as a chance to buy undervalued stocks or sell when prices are overly inflated. Chapter 11. Security Analysis for the Lay Investor. In this chapter, Graham simplifies security analysis for the average investor. He lays out practical criteria for evaluating stocks, emphasizing factors like earnings, assets, and financial stability. This is essential for understanding whether a stock is a good investment or overpriced. The main point is that while in-depth analysis can be complex, even a lay investor can apply basic principles to identify sound investments and avoid speculative ones. Chapter 14. Stock Selection for the Defensive Investor. For defensive investors looking to select stocks, Graham provides a checklist of what to look for, such as large, well-established companies with a history of stable earnings and dividends. He emphasizes the importance of diversification to mitigate risk. The goal here is not to chase the hottest stock or try to predict the next big trend. Instead, defensive investors should build a reliable portfolio with a focus on long-term growth. Chapter 20. Margin of Safety. Lastly, we come to one of the most crucial concepts of the book, the margin of safety. Graham explains that this is the buffer between the price you pay for an investment and its intrinsic value. A wide margin of safety helps reduce risk and provides a cushion if the market takes a turn for the worse. He famously states, "The essence of investment management is the management of risks, not the management of returns." Always ensure that your investments have a built-in margin to protect against unforeseen downturns. So, there you have it. The Intelligent Investor by Benjamin Graham in a nutshell. This book is more than just an investment guide. It's a philosophy that teaches patience, discipline, and the importance of sound decision-making. Whether you're a defensive or enterprising investor, applying these principles can lead to smarter, more calculated investment choices. If you're ready to dig deeper into the wisdom of Benjamin Graham, I've included a link to the full book in the description below. Trust me, it's a must-read for anyone serious about investing.